Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, April 29th, 4:47 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important for next week, and update not the 21 over 21 leaders list. We're going to show 30 survivors. Some are over the 21, some are hanging around the 50, but these are stocks that are bucking the trend for the downtrend, I should say, and may outperform should the market right itself. Some of them are on here, and I would probably have no intention of putting them in a portfolio that we would run, because I wouldn't expect them to outperform the S&P 500 when the market rights itself. But they're the survivors, and being on the list kind of tells you what's been insulated somewhat from this ugly carnage in the market, and today an ugly end to an ugly month. You can see over here on the trend gauge, we've been all red since last Friday when we went to cash. No buys, no sells this week. Can't remember the last time that happened, probably back around COVID. But as far as what happened today, ugly close to an ugly month as support gave way. That 4,200 area that we'd been clinging to gave way, and we headed down, and 11 out of 11 sectors, spider sectors, were all red today. Deep red day. So the G6, our growth proxy, down 3.05%, S&P down 3.6, Nasdaq 100 down 4.5, Dow down 2.8, mid-caps down 2.7, Russell down 2.8, global diversified 60/40 stock bond index down 1.8, and for the day and also for the week, we're flat, all in cash. As I mentioned, we went to cash early Friday morning on the 22nd when the last of our stops got hit. So let's dig into the ugly a little bit, but let's first take a look at the beautiful faces of the team at Revere here. If you're interested in our trend following approach, where we participate in market uptrends, lighten the load a little bit during sideways consolidations, and get the heck out of the way during downtrends, give us a shout. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. We'll go to the tail of the tape and show the indexes themselves. Let me blow this up a little bit here so you can get a good look at the ugly. Okay, tail of the tape. So, as you know, correction, we already talked about that. Same headwinds that the market's been facing for a while. Sentiment getting a little worse, but certainly not enough at this point to stop the market from going down. Put call spiked to 1.27 today. It was 1.3 earlier in the week. VIX elevated at 34. Fear and greed dropping. It's at 28. That's in the fear range. We're very clearly operating under our bear case, which is failure of the prior rally and break of all the moving averages. That was confirmed last Friday. Big news was Amazon just absolutely coming apart on earnings. It has been a laggard for a while, and now down to two-year lows on Amazon, down 14% on earnings. What we were watching today, S&P 500 yesterday, a big key day. It held this 4160 to 4200 area, and then it rallied into this 4300-ish support area where it resistance area where it failed. But today it gave way, never even really challenged resistance, gave way at support. 4160 closed all the way down at 4132. Very much not the way bulls want to see things happen for the S&P. You can see some check marks here from things that have survived. They'll be in the 30 survivor list that we're going to go over. Ones with a red X, a lot of them harsh breaks of the 50-day moving average, so they'll be eliminated from the leaders list. As far as the action happened today, gap down 1%, little bit of a rally, made a 10 a.m. high, but then trended lower. 3 clear legs down, closed near the low of the day. Let's take a look at a 5-minute on the S&P. You can see here the gap down, little rally higher. We peaked around 10 a.m. and then 1, 2, 3 legs down, a little bit of panic selling into the close to put an exclamation point on that third leg down. Closing at the lows, obviously never good. Well, just a tad off the lows, but still not looking good here. Let's look at the Nasdaq 100, which has been even weaker. Let's bring up the daily chart. You can see the break of support here around this 315.50 area that coincides. I don't know if we showed the daily on the S&P to focus in enough on it, but here's this 4,200 area that had held several times this week. Here's the 4,300 area where we found resistance on Monday, resistance on Thursday, and then a really bad day today, Friday, breaking the lows. Still haven't come down to this 41.15 spike low on 224, but that's kind of the action that I'm looking for, is some sort of a capitulation, washout maybe down into the 4,000 area. Let me highlight this. This is what I'm looking for on Monday as a possibility. The 50-day minus 8%. This is where we bottomed on those 124 and 224 shakeouts. The S&P 50-day moving average minus 8% level is down at 40.32. That's 2.4% below where we are. I could certainly see a scenario where a lot of people panic over the weekend. We sell off hard early Monday morning and then do a big reversal off of this 4,000-ish level, which would be a good low risk tactical entry point to see where it goes up, at least into resistance. You can see here we failed at resistance Thursday and Friday at this declining 8 EMA. When you can't get through that initial level of resistance, you're certainly not in good shape in your market. So let's see, sectors. The only thing positive today that I could find was the Chinese ETF KWEB, because the Chinese government said they're going to take their communist boot off of the throat of some of their public companies, and China stocks and KWEB in particular, which trades on the US exchange, rallied somewhat. Some things that were strong early in the day: oils, metals, XME, gold, including gold, and PDBC. PDBC, this is a commodity ETF that we've been watching, led early but turned red by the close. Also down today. Bonds not doing any help to shield a stock portfolio. All 11 of the spider sectors negative, and steel was really particularly hard hit. Let's look at this PDBC real quick here. Broke higher early, made a high for the week, but reversed, still hanging above the 21-day exponential moving average. Looks pretty good. Commodities, hard assets are where money flows to when worse comes to worse in the stock market, and these definitely have been outperforming. You can see this went up from 15 to 19, very quick run in about 2 months before putting in this big consolidation now. So we are definitely keeping our eye on commodities, but for now, oil breaking down somewhat, still holding the 21, but tried to break down on Monday, but then showed some strength over the last couple of days. But even oil not getting away with a big run to the upside with a negative reversal today. But again, it's still above the 21, which is a very positive. Let's take a look at some other commodities. Gold here, under the 50, under the 21, but above the 200. Copper, CPER, breaking the 200-day moving average. That's not good. Let's take a look at wheat, WEAT, breaking the 21, but in a nice consolidation also. This is, for the most part, what some of the commodity ETFs look like, but we like PDBC because it does not produce a K1 form, which can be a headache at tax time. So that's our preferred. So let's go back to the indexes. Dow Jones Industrial Average. Let's take a look at that very quickly. Showing relative strength, as it should. Sitting right around that 3,300 level. It has not undercut its lows from March, unlike the S&P. Let's take a look back here for comparison, which did break them today, and also the Nasdaq 100, obviously. did break also. How about mid caps, MDY? Still hanging around the spike lows from this entire consolidation going back to January, so holding up a little bit. And finally, IWM small caps broke yesterday's lows again, rejected at that declining 8 EMA, making lows going back. You can't even see on the left side of the chart last time it made lows. So back to the tail of the tape. Bottom line, deep red day under the 200-day moving average is when risk increases. We've said it multiple times. We've done webinars on it. We've talked about bear markets and how none of them happen without a weekly close under the 200-day moving average. And it's just, we preach it. When we can participate, we will in counter trend rallies. But when you're under the 200, risk increases, and you end up getting days like today under the 200, where people just want to sell everything that they hold to preserve capital, because a 0% return is better than a negative whatever percent return when you're comparing. When you're being compared to the indexes. So that's why we do what we do here at Revere. For the year right now, we're down about 6% in our flagship portfolio. S&P 500 is down 13.3% on the year. 60/40 index is down 11.6%. The Nasdaq 100 is down 21.3% on the year. The Russell 2000 is down 17%, and the Dow is down 9.3%. So we're negative for the year. Hard to be positive on the year when the index is top on the first trading day of the year. As you can see here that they did on 1/4. Actually, I guess that was the second trading day of the year, 1/4. We were positive on 1/3, made a higher high on 1/4, and that was the high for the year. And ever since then, it's been waves of selling, and now it looks like this third wave down. This being the first one, this being the second one, this being the third one. This third wave down seems to be in control. So as I said, bottom line, deep red day, under the 200-day moving average, increased risk. The next area to watch is this 41.15 spike low. And then if we get a capitulation move down to 8% below the 50-day moving average, it's down near 4,000, more specifically 40.32. So let's go to the 30 survivors now. And we're going to put them in, sort them in order of 3-month relative strength. Okay, so these all should have decent relative strength, and some of them over the 21. Some of them we're really keeping an eye on. Some of them in here just as a placeholder to demonstrate what's holding up. But what they all will have in common is they're at or right around the 50-day moving average, showing some relative strength. The standout, Lantheus Holdings. This has been in the 21 over 21 for quite a long time. Reported earnings today, closed mid-range, which is rare. It is a medical stock, so it's really tech stocks that get hammered. But with a PE of 42 and a nice 318% growth rate for 2022, people not anxious to take their profits in there. That's holding up pretty well. EQT is an oil and gas integrated stock, holding up better than Exxon and Chevron, which is in the same group. Reported earnings this week, holding the 21. Exxon sitting right on the 21. Chevron broke the 50, hanging kind of around it, but EQT looking better than both of those. Let's move on. Arch Coal, which we punted last week, but got back off on after we punted last week from the 21 leaders list. But great reaction to earnings, big move up 20%, and flagging since then, still looking fine. CAR, I've been reading a lot of articles about how difficult it is to rent a car, how they're jacking the prices up. Demand is there as people are traveling after being cooped up for COVID. This is a pretty decent looking chart sitting right there around the 21. Nucor, a survivor, hanging right around the 21, even though it was down 3.7% today as steel stocks had a bad day. Occidental sitting on the 50, 21 acting as resistance now, but this one's holding up pretty well and still showing relative strength from the oil perspective. Delta Airlines looking pretty good. Actually, you could also have United, American, or LUV Southwest on here. Those are holding up pretty good, but we put Delta the best of the four on this list. Kimberly-Clark, gap up on earnings, not giving any of it back, not breaking the low range of the day. Maybe people need diapers to protect themselves when they open their statements at the end of this month. Not Revere clients, though. KHC, Kraft, defensive, very obviously broke out of a cup and handle and actually holding that, pulled back and touched the 21, but holding up okay. CF Industries holding on to the 50-day moving average. Agriculture and oils have been the leaders in here, and these haven't broken yet, although that does look kind of bear flaggish as it's riding the 50-day. DLTR still holding up, broke the 21, but above the 50. Costco broke the 50 today. Not looking too good there. Let me put that on. Costco, you can see breaking below the 50-day moving average. Now, Costco has a pretty high PE. It trades at a premium, and high PEs are getting shown the door today regardless of what industry they're in. New one we haven't talked much about before, but acting very well, Waste Management. Little gap up on earnings to the top of the pivot. Nice looking chart. Merck, good reaction to earnings. Day two higher high at the top of a cup and handle. Marriott, travel stocks, acted very well 3 weeks ago, pulled back over the last week and a half, but holding the 21 with relative strength at a new high. Starbulk, this one has survived the shakeout of the shippers very well, just barely below the 50-day moving average. Ulta Beauty broke the 21, but still above the 50. This has had a decent run since earnings. Its last earnings report when we got shaken out down here around 360, ran away without us. Walmart, I mean, when you think about where you're going to shop to save money in a trying economy, Walmart very clearly comes to mind. Broke the 21, but firmly above the 50 at the top of the pivot here around 152. Hershey, everybody loves chocolate, above the 21. PKG, Package Corp, all those Amazon boxes. Yeah, Amazon had a tough quarter, but they're still shipping a lot, but their margins have been squeezed because of transportation costs and supply chain costs, but PKG holding above the 21. Vertex, earnings next week, but above the 21. Johnson & Johnson, positive report on earnings, holding the 21. PepsiCo, I have this on here instead of Coke because they've got the Frito-Lay component, which is a big part of their profits. That's a pretty good looking chart. KO looks good too. Also, Procter Gamble, the ultimate defensive stock, holding above the 21, right around its pivot. General Dynamics holding up the best of the aerospace defense stocks, clinging to the 50-day moving average. ASO, Academy Sports, not the best looking chart, but this one, I'm paying attention to how it really hasn't given up much since its earnings report, and from a relative strength standpoint, it's holding up pretty well. IBM gapped up on earnings, ran into 140, couldn't go any higher, pulled back, sitting on the 21. Devon Energy sitting around the 50-day moving average, still showing relative strength. They're in oil. McDonald's, go order off the dollar menu if you want to save some money, sitting on the 21. TECK, metal and mining stock with a great reaction to earnings. Higher high on day three after earnings. Anytime you see earnings and it doesn't get immediately sold, those are survivors and we're paying attention to them. And finally, a new one, OLN Chemical, Olin Corp, gap up on earnings, closed at the bottom of its range, but one we want to keep an eye on for that. And those are the 30 survivors. And that's going to wrap up this week's video. As always, love to hear from you. I'm on email at you can email me, don@revereasset.com, or you can phone 855-REAL-WEALTH. So discretion, the better part of valor, staying in cash in this type of market. We're surviving fine, very tough month for the indexes. You have any questions, by all means, reach out. So wrapping up the week and the month ending on April 29th, this is Don Vandenbord telling it like it is. You might not like to hear it, but it's the facts. Thanks for listening. Have a great weekend, and we'll see you next week as May kicks off.